Got very, very lean, which has always been the promise to our shareholders. We're driving for EBITDA this year, and I think Q1 puts us in a great position to do that by year end. They're stable, so
Yeah.
47% gross margin. And I think, investors can go back through the history of our financial statements. We've solidified that as our business model. The last 3 or 4 quarters, we've hit 45 plus gross margin. It's a really strong indicator that it's a high margin business and it's also a scalable business. So let's talk about Zambia in general. First thing to know is yes, this project is turnkey right now. Everything is in place from our EPC. So we have MOU with Power China, one of the largest construction companies in the world, that's going to be actually executing the project for us. And they're already stationed in Zambia. So they're building the roads there, the dams, a lot of the infrastructure in that country, and they will be the contractor to build out our project in Zambia. So you got an A-plus contractor that's going to do the construction. The second thing is we did, like you said, get EDC support. So we now have insurance from the Canadian government up to 2 million USD on the energy receivables in Zambia for a very digestible policy. You'll see in the next 5 to 10 years, the price of energy is going to skyrocket for not just households, but for business owners as well. So the demand for what we're doing is right here. It's coming. We're on the precipice of that demand.
Stardust Solar is a global provider of renewable energy systems and services and projects. The company just released its Q1 2026 results, and CEO Mark Tadros is here to review the quarter, some recent milestones, and upcoming catalysts. This is neither a recommendation or investment advice. We're here to learn about the company. I'm Martin Gagel with Market Radius Research. Mark, thank you for joining us.
Hey, Martin, thanks for having me.
All right, maybe just go a little bit over the quarter, if you don't mind me saying. It was a tough quarter, but you've made also a lot of improvements in there. It's a bit of I don't even know if a mixed bag is the right way to turn it. Given the challenges, you've got a lot accomplished, so there's a lot good going on there. So why don't you go over the headlines and we can get into a bit of the details.
Yeah, and I was actually quite happy with Q1, to be honest with you. It's important to remember our business is seasonal, and Q1 is always our slowest quarter of the year. But there are also additional headwinds in our industry, specifically in the US politically, and in Canada, the economic situation. We're kind of in a light recession, if you will. But all that being said, we still finished Q1 with just about $800,000 in top line revenue. I think it was 775 was the exact number. And we only had a loss of 100 grand on that quarter, which is a 13% loss and a significant improvement on our operational effectiveness compared to last year's Q1, where I think we had like a 65% loss on $1 million. So although our top line reduced a little bit, we got very, very lean, which has always been the promise to our shareholders. We're driving for EBITDA this year, and I think Q1 puts us in a great position to do that by year end.
Just to highlight, your gross margins dropped a little bit, but in the mid to upper 40% at 46 or 47.
Actually, yeah, they're stable. So
Yeah.
47% gross margin. And I think, investors can go back through the history of our financial statements. We've solidified that as our business model. The last 3 or 4 quarters, we've hit 45 plus gross margin. It's a really strong indicator that it's a high margin business and it's also a scalable business. So as we get a little bit bigger, those gross margins will continue to carry along and create that long-term EBITDA that we're looking for.
And you are able as well to cut your SG&A dramatically, reducing, despite the lower revenues, you kept margins up, cut costs, so you're able to dramatically improve the net loss for the quarter.
Correct. And we're
Yeah.
continuing to cut. So we're not done yet. And you'll see that to continue to improve. And I've said this a few times in our interviews, it's just about experience. We've
Mhm.
been public since 2024, October of 2024. And we're learning where it's important to spend capital and where we shouldn't. So those cuts will continue. We'll continue to get better. But yes, you're right. It's reflected in our Q1. You'll see that some unnecessary expenses no longer exist in our company. And actually, I'd like to just take that one step further. There's a specific account in our financial statements, which is advertising and promotion. And I think some people might look at that and it's too much of a general term for my flavor. Maybe at year end, we'll break that up into operational advertising, which is when we're promoting our services and going to find franchises or clients or projects. And then there's IR, which is really the promotional stuff that we've cut drastically and found there's not a ton of value in spending in that. So, but overall, the account of advertising and promotion has come down significantly. It'll continue to do so. And we will segment that account in the future so investors get a really clear picture of what's operational advertising and investor relations.
So, why don't we talk a little bit about the solar market in general? Canada's got a bit of a recession. Some incentives have been removed. In the US, obviously, all sorts of stuff is going on. But there's, given the high electricity and inflation and energy prices in general, people are trying to find new ways to save money. And especially in some parts of the US, solar is such a slam dunk.
Yeah, so absolutely. You're correct. There's headwinds and renewable energies in general right now, but that is short-lived. There will be a rebound in the market, just like there is in every segment of the public markets. There's peaks and valleys. So right now, in the US, the administration is, calling renewables a hoax or pushing back on it, negative sentiment, repealed an incentive on ITC, a tax incentive. So it's, been a little bit more difficult there. And then in Canada, you're right. We talked about this in the opening statement. Canada's in a light recession, I guess you can call it. I don't know if, you can say light or technical recession, but
Yeah, we're
yeah,
having our challenges. Yeah.
yeah, exactly. Right. So there's definitely headwinds on the industry, but I think this is the most important concept for any of your listeners and shareholders at Sun. Energy is going to be in demand and in very short order, if not already. And we are in the energy markets. So going forward in the next 6 months, 12 months, 24 months, there's going to be a massive demand for energy just based on data centers, AI, robotics, EVs. All of this stuff is going to have a huge demand that's not even present today. So what does that mean? Energy prices are going to go up. There's going to be inflation on the energy markets in general, not to mention what's happening in Iran and globally. So if there's inflation on energy, you're automatically going to have a demand for alternative solutions. And here's the best part: the sun never charges you inflation. And what do I mean by that? Once you install solar on a building, whether it's commercial or residential or even utility scale, your costs are sunk. And as long as the sun comes up in the morning for the next 30 years, there's no price increase on your energy generation. You've already paid for it. Whereas you'll see in the next 5 to 10 years, the price of energy is going to skyrocket for not just households, but for business owners as well. So the demand for what we're doing is right here. It's coming. We're on the precipice of that demand.
And as well, you've been, I'll call it creative in trying to find new business opportunities. And I think Zambia comes to mind on that. Why don't you give us a bit of an update on what's going on in Zambia? You had some recent news with EDC Insurance, which is a nice de-risking event on that initiative.
And I think, before I dive into the project specifics in Zambia, I'd like to just also highlight that it is diversifying our offerings for our shareholders, right? So we're not just based on our North American production, but we've now gone international. And there's an opportunity here for Stardust to become an energy producer for a foreign government. It's a very big leap forward. And I don't want to give the misconception that we're moving away from the historical franchise business. No, nothing could be farther from the truth. The franchise network is the backbone of the business, but our franchisees develop opportunities and they bring them to us at head office and we select, those best opportunities and we invest in them, which is how this came to be. It's not that we're moving away from the franchise network. We're adding to our revenue profile. Okay. So let's talk about Zambia in general. First thing to know is yes, this project is turnkey right now. Everything is in place from our EPC. So we have MOU with Power China, one of the largest construction companies in the world, that's going to be actually executing the project for us. And they're already stationed in Zambia. So they're building the roads there, the dams, a lot of the infrastructure in that country, and they will be the contractor to build out our project in Zambia. So you got an A-plus contractor that's going to do the construction. The second thing is we did, like you said, get EDC support. So we now have insurance from the Canadian government up to 2 million USD on the energy receivables in Zambia for a very digestible policy, which we shared in our news release and can be found on our website. So the EDC coverage also ensures shareholders that we have some bankability to what we're doing and that we're guaranteed to get that back. Third, we're moving towards potentially building an SPV. So I'll be careful with this one because we're currently in negotiation, but the project is turnkey. Boots on the ground are ready to do the construction. The only thing we're missing now is to select our financier for the project. Now, in terms of hearing from shareholders and discussing with some of our bigger shareholders, we've decided to look at an SPV in Zambia, special purpose vehicle, to take the risk outside of the public company and have everybody put the assets and the funding into that SPV to take the risk out of the public company. So that's still currently in negotiation, but it is I'm going to call preferred structure that we're getting from a lot of our lenders. And we have currently 5 very advanced discussion with different lenders from around the world. Some parts of Europe, some are already in Africa, and some are here in North America. So in totality, I think the message is for your listeners, we've done a ton of homework on this project over the last 12 months. We have a government guaranteed PPA in Zambia. We're working with a top construction company, and we have EDC insurance on the project. Finally, using an SPV offers that ultimate layer of security that this project would not affect our stakeholders.
And the structure behind the SPV, you need to invest some money into the Zambia project. And instead of, let's say, diluting Stardust to then fund the project, you would dilute the project itself. So at the end, you wouldn't own 100% of it. You would own whatever, 50, 60, whatever that number is. And someone else would invest money into it and then own that portion of the SPV. So you wouldn't get all the economic benefits of it, but you wouldn't have to invest as much or any more money into the project. Is that the basic structure?
That's the goal. Yes, you're
Okay.
correct. And some of the discussions we've had is a 30% equity, 70% debt scenario where a financier would take a piece of that SPV, but then ultimately get paid back 70% through the energy revenues of the SPV. But, there are multiple parties involved. And yes, I think us ending up with maybe a smaller piece of the entire project, but like you said, having the risk inside the SPV is a good long-term result for our shareholders. It gives us still long-term revenues from the SPV for 20 years. And ultimately, I think what's most important to us at management is it brings the project to life. And we check that box. We achieve the power generation and the revenue, and we can now take that model and bring it to other parts of the world.
Okay, so that's moving forward. So over the next, I don't know, couple weeks, couple months, we should get some news on how the funding of that project is moving forward, hopefully.
Yes, hopefully within the next few months, we'll have some announcement there. And that is really the last piece. Everything else is ready to go. We'll keep everyone closely updated. And we are in advanced talks at this time.
Another one of your initiatives you're working on is the lease to own through
Great.
the franchises, which it's an interesting model, but at the same time, that requires a balance sheet to help fund these projects moving forward. And your balance sheet isn't as robust as maybe it could be to fund these kind of projects. How are you going about? Are you looking at some other structures to try to fund this lease to own model?
Yeah, so let's talk about lease to own. And, I'll just start by saying we did build this model specifically to reinforce our franchise network. This will allow them to go out in the field and get more residential and commercial projects because we have our own internal financing. For those that know the industry well, they'll know that the financing options available right now are not good. They're very expensive from private lenders and third parties and lots of fees. But internalizing it allows our franchisees to be extremely competitive in the market, and it solves the primary problem in the industry. So yeah, lease to own, the concept is really easy. We will pay for the project, we will fund the project, but Stardust will own the assets. Okay, so we will own the energy producing assets on the buildings, whether it's a home or a commercial building, adding to the balance sheet energy producing assets, which I believe are only going to go up in value into the future. Now, for the building owner, again, residential or commercial, they get to benefit from the energy produced. So their electrical bill, let's just say, was $200 a month. It's now a $150 lease payment to Stardust. So they're net positive on their cash flow on day one of doing the transaction with us. So the model works really, really well from head office to the franchisee being paid to execute the project to the building owner receiving the energy. But you're right, you need to find a way to finance that. So we have a dedicated account that's specifically for lease to own. And we actually got approached just last week from an investor out of Toronto that's interested in putting $1 or $2 million specifically into this program because they recognize the high probability of return on the loans that they're going to be putting out. You got to remember when we go and put all this equipment on these buildings, we lien all the assets, right? So a homeowner or a building owner is always going to pay back a $50,000 or $100,000 project versus losing their property. So what I'm trying to say is they're very, very secured loans. We do have interest in investing specifically in lease to own, and then that allows us to advance a lot of projects for our franchisees and bolster our network while there's headwinds on the industry, and ultimately loading up the Stardust balance sheet with energy producing assets that we own.
Your franchise model, you increased the number of franchisees in the quarter, and you can you just talk about how the franchisee model is going right now? You're adding. I'm really actually impressed at how many U.S. Franchise you've had after the political stuff. I thought that was going to be a lot weaker, but you're still seeing some growth there. So tell us how that whole franchise model is working out right now.
So we're sitting at 106 territories today. You're right. We've recently added some in the US, Phoenix specifically, South Carolina. So there's going to be continued growth, I think, just because of the market size in the US. And a lot of people understand that, rhetoric is not always reality. And people recognize the long-term opportunity of getting into the business. So yes, it is continuing to grow. We're talking today there's a whole bunch of potential franchisees coming in Q2 and Q3 that are in the works. So it continues to grow. But I do actually want to, put a little bit of a preface on this, that we are also going to be cutting some of our non-performing franchisees. And, that may sound a little bit cutthroat, but it's part of the model. There's a minimum requirement for $250,000 in top line revenue at the micro level, at the franchise level, to maintain your license with us. And those that don't perform, we have the right, not the obligation, but the right to repeal that territory and sell it to somebody who will. So there will, although we're at 106 today, there will be some cuts made. And we do this every year, maybe 5 or 10%. I'm thinking this year it'll probably be closer to 10 or 15%. So we'll shed a bunch of, poor performing territories. It reduces the amount that we need to focus on, and it allows us to really optimize the ones that we're working with. But more importantly, it creates new territory for us to sell at that high margin franchise initial fee.
And then hopefully get higher performing operators in the location
Yeah,
as well who can keep
that's
it
the
going.
concept. That's the idea. Yeah.
Your share price recently has been under a bunch of pressure. As well, you've announced a financing. I believe you've closed a small first tranche of that. How is that going? And I don't know, what do you want to tell shareholders at this point with the state of the financing? Looks like you're building out some financing alternatives with the Zambia SPV, maybe some lease to own stuff. So, where are we on that external financing path?
No, and I appreciate that question. It's very relevant at this time. So first thing is, yes, we're under pressure. We're incredibly undervalued, in my opinion. Of course, every CEO is going to say that, but I almost find it comical based on the industry we're in. That being said, let's address the question. We did announce a financing, and it had a specific purpose. And it's also the reason that we're a public company is because we want to be able to raise capital to advance our initiatives for the benefit of our shareholders. So for detail here, we launched a $3 million financing 30 days ago. I believe it was just over 30 days ago. Since then, we've reduced that to $1.5 million financing just based on shareholder sentiment. So I want the shareholders to recognize that we hear you, and we did bring that down. Now, the financing was, yes, originally designed for three things. One is for the Zambia project and to advance that there. Two is to pay the convertible debenture we took at the beginning of the year to advance our projects. And three, for operations. Now, what we've done is we've explored external financing for Zambia, so you could take that off the table. Two, we still want to pay back the debenture because we don't want to carry long-term debt on our books. And three, there still will be some going towards operation and growth initiatives of our existing business model, the franchise network. So we stand behind why we're raising the capital, but we've reduced it to reduce the dilution. And the financing is actually going reasonably well. You're right. We closed our first tranche of $500,000, which is 33% of the allocation. We're going to be closing our second tranche, which will likely be our final tranche at the end. Well, I don't want to give a specific timeline, but in the next few weeks, we're going to be wrapping the entire financing, and it'll be off the table. We can just get back to, building the company, building the stock, and creating shareholder value.
Mark, you went public almost 2 years ago now. How much capital have you raised, I guess, going public and since going public? Because as a public company, that's kind of the point. It's a growth company. You go public so you can have access to public capital and use that to fuel the growth. How much has been raised so far?
We went public in 2024. So since 2024, we've raised a total of $2.4 million, I believe, or 2.5 maximum through private placements. So that's just a little bit over $1 million a year. And it's, I think, to be expected that we'll want to be raising capital once or twice a year to continue to scale up the project. So, historically, the dilution hasn't been so severe. I think, the pushback is that it's a little bit of a down round that we did this year from 10 cents to 7.5. And I understand that, but it's also important for us to continue to grow the business. And ultimately, the value on the stock will come back with the growth of the energy market and if we're responsible with how we build out our operations.
All right, I think we've covered a lot of territory here. Any final words or thoughts before we wrap it up?
Yeah, I think we did a great job of covering all the pertinent issues. I guess maybe my final thoughts is opportunity. The fun thing for us that maybe the shareholders don't see is there is mountains of opportunity coming at Stardust Solar right now. We're getting a lot of international exposure. We're preparing to do a project in Mexico that's going to be very exciting for us. We're going to be developing the entire country of Mexico over the next few years. That's a really big initiative for us.
Sorry, and that's with the franchise model, or
Correct.
in
We'll
which
be
way?
opening, that's right. We'll be opening franchises in Mexico with a key partner there. We'll also be chasing larger scale projects there as we develop the market. But the international theme, I think, is what's really exciting for us. The scalability, the flexibility of the franchise model is so well adapted to grow anywhere, which I wouldn't say is a surprise, but it's something really exciting for us that we didn't anticipate how quickly we could deploy that. There's also an opportunity right now in Switzerland where someone we're negotiating very seriously with, buying 26 franchises there for every major city and scaling up those opportunities. So I think I would leave that final note is that while we have our backbone in Canada and the US, we are now expanding our franchise network internationally. And I think with the growth of the energy markets in general, we'll have a lot of opportunity, not just in our own backyard, but around the world to keep scaling up the business.
Thank you very much, Mark. Good talking to you, and talk to you again soon.
All right. Thank you, Martin.